Hi everyone, Ira Coiner here. Welcome to another episode of Triathlon Partners TV. Today's topic we will be discussing the very prevalent investment option in insurance products and annuity products. It's called point to point. Now I've gone on a lot about these products and I wanted to delve into the actual underlying investment so everyone understands what it is and why I think it's an excellent long-term investment choice. Now, these point-to-point investments, what they are is it takes a popular index like the S&P 500 and it takes day one of when it's invested and the last day of the term, which is a year, and it calculates the percentage change. Now, if that percentage change is below a certain level, the point-to-point offers a floor, a minimum loss. And on all insurance products, that minimum loss is 0%. So if the S&P 500 is negative for the year, your investment has not lost any money. It's because it has that floor at 0. Now, in exchange for that fantastic floor, that you can't lose money in a year, there's a cap, which means you can't earn more than a certain amount each year. That cap changes year to year. So if the S&P 500 is up more than the cap, you only earn the cap, right? It's fair enough. And if the S&P 500 return is between the floor and the cap, you earn what the S&P 500 has actually performed, right? And you get that interest credited to your account and your cash value, investment value of the insurance product grows at that rate. Now, one of the reasons why I think this is great is that you don't have any negative values, right? So negative returns over the course of the years. And let me explain why that's really important, right? So if you were long the S&P 500 and you would have a year, and we've had years like this very recently, that the market is down. So let's say the market's down 20%. And the following year, it's up 20%. Well, the average is 0% for those years, but it really isn't the performance that your portfolio has experienced. Because if we take an investment that's $100 and that first year you lose 20%, you're left with $80. And that second year, when the market's made 20%, 20% of $80 is 16. So your balance at the end of that second year, being up 20%, is at $96. You're still $4 short of 100, right? So you're actually down 4% after the 2 years. Now, if we put that into a point-to-point strategy instead, well, that first year, you're not down anything. So that $100 is still worth $100. Then that second year, your cap is, let's say the cap is 10%, which is very realistic. That second year, the market's up 20%. You're only earning first 10%. So at the end of the 2 years, you're up 10%. You have $110. You don't have $96. So you actually have $14 more dollars, which is going to be a little bit more than 14%. 14% profit as opposed to negative than the traditional we're investing only in the market without this point-to-point strategy. So I think that's really important and it's really great. Now, when we look at all these, the point-to-points, what it really has is it has less volatility than investing in the underlying index on its own, right? That floor has, caps the losses, and the cap caps the gains, right? So the range of outcomes is limited. It's all on the positive side, right? So a lesser volatility to have in your portfolio is quite good, right? It's much more predictable. And we know all these returns are positive because just because volatility is less doesn't necessarily mean you can't have negative returns. Now, something that a lot of money managers like to do to diversify a portfolio and to put in a different asset class that has a lower volatility, they like to buy bonds, right? Now, bonds, they pay an annual interest coupon, but sometimes the price of bonds goes down and you can lose money in a year in the bond market. So you don't have that floor, you're just not earning interest. And when we look at the long-term returns of bonds, the 10-year bond, government bond, has averaged 4.25% over time. Now, the last reading of the 10-year bond was close to 4%. So right now we're just a little bit below the 4.25. But when we compare this to the point-to-point strategy, and there's a major carrier right now with the S&P 500 point-to-point with a 10.25% cap. And over the last 20 years, when we go back and look at it, it's been averaging about 6.6%, right? So when we take that difference between the 6.6 and the 4.25, you're actually earning 2.35% more a year, right? Which is actually quite substantial when we're looking at an investment that is a long-term investment, 20, 30 years, right? So when we think about this, even going a little bit more granular, right? The life insurance product is an investment that is sitting in a tax-deferred vehicle, so you're not paying taxes on that. Whereas if you have this fixed income or U.S. Treasuries in a taxable account, every year that interest gets taxed, right? It happens if you live in a big blue state, in a city, such as New York or San Francisco or LA, your marginal tax bracket between federal, state, local is 50%. So if you're thinking, well, this is really great, I have some fixed income, I'm earning 4%, I'm happy with that, you're earning a lot less because that 50% goes to taxes, you're only taking home 2% of your money. So again, it's great to see account balances go up, but real wealth and accumulation is about the amount of money that goes into your pocket, right? So I think that's very important because you're actually dealing with these point-to-point strategies to have about half the volatility of the S&P 500, yet they return about 25% less on average over time because you don't have those negative years, right? So we look at those years that the S&P 500 might be up 30% and you're only earning 10, but the years that you're down 10% or 20%, you're not down at all, right? So it does make up quite a bit, and it's a good way to diversify your portfolio. You have to keep in mind that it's, maybe the S&P 500 on its own is a better investment, but we're looking at a volatility standpoint, and holding this instead of some fixed income is actually a very good idea, right? So that's what the point-to-point strategy are, and there are a couple of different variations of it. Some of them are a little bit better than just the S&P 500 on its own, but it's the easiest one to understand. And I hope this really gave a good foundation to understand why I believe this is a great product to incorporate in your overall portfolio, right? And that it's in life insurance, you're getting these deferred taxes on the gains. They're not paying taxes. And when they're structured properly, these insurance products, the payments that you can withdraw at retirement will be tax exempt, right? So this is fantastic because when I'm saying they earn 20% less than the S&P 500, if you're not paying taxes on this money and you're paying taxes on money that's on the S&P 500, and you have a 20% tax rate or 25% tax rate on your long-term capital gains, they're actually returning about the same amount of money, right? So to have half the volatility and the same amount of cash in your pocket is super fantastic. All right, so once again, Ira Coiner here from Triathlon Partners TV. Thanks for tuning in. Our goal is to engage, educate, empower our clients so they're able to make the best decision that fits their financial objectives. And I hope this was a fantastic learning experience, and everybody have a blessed day. Take care. Bye.